afternoon or good morning, wherever you are. Well, let's hope the world is not coming to an end. Certainly here at UNT, we are now besieged by, I guess, the coronavirus and what's happening in the world. And we have moved to online classes. I never personally ever wanted to do an online class because I love the interaction of students. I love seeing your faces here. I love trying to engage you, get you off your phone, wake you up, whatever it takes. But hopefully, I'm trying to bring the same classroom experience to you, using the same classroom as my 11 a.m. class. And hopefully I'm going to figure out how to get all of these videos posted. I'm certainly putting the same effort into teaching the class that I had done in the past. And so we'll start here. This is chapter 19, share-based compensation. And so this is a very interesting subject, and the FASB had a long road to decide that we needed to expense share-based accounting because we are not paying in cash. And this back in the 90s, in the dot-com boom, where Amazon and a lot of these companies got started. At that time, everything was a dot-com company. Everything, we thought the world was going online, and it wasn't at the time. In fact, there was a big the bubble burst in the late 90s, and all the stock prices dropped. But we're pretty much here now with a lot of online. But those online companies did not pay. They didn't have cash. They didn't pay employees in cash. They paid with stock options and shares. And the FASB realized that's something that we should be expensing because executives are providing services to the company, leadership to the company, accounting, all of that, and they would be paying not in cash but in shares. And so the FASB first venture at requiring the expensing of share-based compensation just met with great turmoil, and even Congress got involved. I am sure the lobbyists were pushing from these high-tech companies were pushing their congressmen, and the FASB actually backed down at the beginning. And so it took several years for the FASB to come back, and they experienced the same pressure, but they pushed forward because yes, this is an expense. This is nothing more here in this chapter, debiting expense, and instead of crediting cash or salaries payable, we're going to credit equity, because the company's going to give equity to executives in exchange for their services. Now, you'll see that there's three types. I'm going to, we'll get into the details here in a minute in the chapter, but there's three types generally of shares offered to the company. Number one, which we'll see here, is restricted stock. The company grants executives X number of shares, and they're restricted. The executive will not receive dividends on these. They'll not be able to sell these shares. Basically, they don't really even own these shares until they've achieved the end of a vesting term. For my companies, both at Maytag and Lennox, it was a 3-year vesting term. So at the end of 3 years, if you stayed there 3 years, the restrictions were removed, and then you owned those shares. They were dropped into your brokerage account. You could do whatever you want. That's restricted shares. The second type that we'll see are stock options. And so the company will grant you an option to purchase shares at an exercise price, and under the rules, it's a different accounting if you don't, and the day one of the grant, the day the stock options are given to executives, is the fair value of the stock on that day. And everything we'll look at here will assume that. There are a lot of nuances with this accounting that we won't get into in the chapter. You'll learn the kind of core logic here, but not all the nuances. So the executives offered options to purchase usually kind of a large number of shares at that price on day one. And again, there's a vesting period. And at the end of the vesting period, the executive could buy those shares at that exercise price. And if the shares have gone up extensively, they can sell them that day. And usually, stock options will have a vesting period, but also a life, a term. For example, at Lennox, we had a 3-year vesting period for stock options. And so at the end of 3 years, these stock options will remind or executives to do what they want, and they can exercise them, buy the shares at a low price and sell them at a higher price, or they could keep those stock options live for 7 years. So the term of the stock option was 7 years. So between years 3 and 7, they could just hold on and see. It's kind of a bet here. As the stock go up a lot, can make a lot of money. Stock options, big wealth builders. And then the final form of stock grants is called performance shares. And we had at Lennox, we had both restricted stock options, and we had performance shares. And so that's a restricted stock grant, an X number of shares, but if the company performed certain metrics very well, they could double up to 200%, or if the company didn't perform in those metrics, they would be zero. So those shares could pay out between 0 and 200%. And those are called performance stock options, performance stock grants. So again, restricted stock options, and performance stock grants. And we're going to do the accounting for all that. Just an aside bit, as an executive, I remember in December, I got my first grant from Lennox, and it was valued at $75,000, which was the grant as a restricted stock. Got published in the security. These for executives are published and they're online. And I got a call from my dad and said, "Man, you've only worked there 3 months, and they've given you $75,000 already. What the?" He wasn't happy for me. I was expecting, I thought my dad would be proud of me. He said, "Why, they're just paying you too much." I said, "Dad, come on. I got to stay in this company for 3 years as the chief accounting officer. And the likelihood of me surviving all 3 years is probably low, because chief accounting officers make mistakes, they get fired." And so I said, "That's worth 0 right now. Talk to me in 3 years." And so he didn't understand all of that. But so the vesting period. So, I did vest in those shares. By the way, the stock had, I think, about tripled at that point. So they were worth a lot more than $75,000. But I never called my dad and bragged about that, because he would have said, "Hey, you executives are getting paid too much." And sometimes I told my staff, I said, "Wow, this executive compensation is too much. It's excessive." And they would always laugh and say, "Well, are you going to give some back?" And I said, "No, I'm going to keep it, but it seems excessive." And why would I say that? It just can be very large numbers. When I joined Lennox, the stock was trading at $20. When I left Lennox, it was trading at over $250. And so you think about the CEO who got a lot more shares than me. It was a very valuable package for him. But I will say this: it served 2 purposes, these share-based compensation for the company. Number one, it lines up the CEO and the whole management team with what shareholders want, which is a higher stock price. That's number one. Number 2, retained. We can, not everybody will make it all 3 years, but it'll most likely be at the company's choice. And so at Lennox, we did not have a lot of executives leave voluntarily, because they knew they had all these stock grants outstanding. So that's kind of a background for share-based accounting. Let's get into the slides here. So share-based forms, hey, they're tied to the market price of a company stock. So this is going to be really good for shareholders. They can have stock option plans. We'll get into all this. And the goals are to try to, have executives lined up with shareholders to perform and make sure the companies perform at the highest level. Now, in accounting, we're going to look at one thing, day one. This is very important here, and we'll stop here for a minute. We're going to expense the fair value on the date of grant. And the FASB struggled with a lot of different options. So that stock that tripled for me is only fair valued on the day I received. Even though the fair value may go up, may go down, we stick with that fair value on the very first day of the grant. And that's what we're going to expense over the vesting period. Because there's a service performed, for Lennox, I had to work there for 3 years. So we're going to expense that over the vesting period. And so whatever the fair value of the date of grant, and we're going to expense that pro rata over the vesting period. Keep that in mind. That's the basic principle behind all of the accounting here. And what we're saying here, expense the compensation over the periods which companies perform the services, right? That's salary expense. Executives are providing services over that vesting period, and so we want to expense it, the benefits the company's receiving from the executive over that vesting period. So fair value, day one, expense over the period that executives are providing service. This is the basis of all share-based accounting. Keep this in mind as we get into the weeds here. And so we're going to look at restricted stock first, and that's like the first one I shared with you, where executives are granted shares of stock. They're restricted. They don't receive dividends. They're not allowed to vote these generally, and the restrictions removed at the end of the vesting period. And they're going to use this term restricted stock awards or restricted stock units. The accounting is the same for both, so I'm not going to get into the legal nuances there. At Maytag, where I worked before, we had stock awards. So it was actual shares of stock that had restricted written on it. And at Lennox, it was restricted stock units. So it wasn't a share of stock, but it was a unit that at the end would become a share of stock. So to me, these are more kind of legal things. Since the accounting doesn't change, I do not want you to worry too much about that. So, awarded in the name of the employee, and physical possession, 99% of the time retained by the company, but all rights to those shares are in the company. They're not in the executive's hands until the vesting period's over. And forfeiture, they're subject to forfeiture for any reason that if the executive is not employed by the company on the last day of that vesting period, then the employee the executive does not receive those shares of stock. And we're going to have to consider forfeitures when we think about the expense, because if you look at executives around the company, the average is probably 40-50% or more of executives do not stay with the company for 3 years. Number one, they may not be happy and pursue other opportunities. Maybe they get promoted, but more likely is the case, they get fired. And I remember the VP of HR at Maytag told me once, all you executives, you love the big compensation, the share-based compensation, but you forget high reward, high risk. Executives are held accountable, they get fired. When things go wrong, they don't look at the employees, the CEO, the board, they're going to look at the executives. How did this happen? What happened? And so you'll see a lot of forfeitures, involuntary forfeitures, and when that happens, the executive loses all of the share-based compensation they've been awarded. They only retain the amounts that were vested, and so there'll be a lot of 3 years worth of vested stock options that they will not receive. Restricted stock units, RSUs, it's not a share of stock during the 3 years, but at the end of the 3 years, they get a specified number of shares. And so, again, this is more semantics to me than anything else. And I'm not going to really get into that. So let's look at, here's restricted stock units. And so here's an example. The company has granted 5 million, in this case, RSUs, that will be paid in stock. It's $1 to certainty on January 1, 2018. And they're subject to forfeiture, so the vesting period is 4 years. So the executive has to remain with the company for 4 years to receive those shares of stock. So any reason that they leave the company before that, do not receive it. And so for 4 years, the executive's at risk of losing those. So that does motivate people, to keep their shares. And so January 1, we have no entry. Step one in the accounting is to calculate the full fair value of the grant on day one. And if that fair value changes later, we ignore it. And so on day one, the current market price of those shares was $12. If that stock price goes to 5 later, if it goes to 100 later, we stick in with the $12 on day one, date of the grant. And so total value of the compensation expense, $12 a share, 5 million shares granted. So the total value given out on day one was $60 million. Fair value on day one. Again, We ignore future changes in that. We stick to day one, 60 million. Then how many years does the employee have to work there and be employed and be engaged in the company? 4 years. So pretty easy. 60 million divided by 4 years of service. We are going to expense that at 15 million per year. Debit salary expense 15 million, and we're going to have to credit equity. And this is where the accounting gets a little bit more complicated. So for 4 years, we debit compensation expense, and we credit this account. It's in additional paid-in capital on the balance sheet, but we keep a separate one, paid-in capital, restricted stock, 15 million. So 4 years. So at the end of 4 years, we've got 60 million. We've expensed 15 million a year going through retained earnings, and 60 million sitting in that additional paid-in capital account. We get to the very end, and we grant the shares. Hey, remember this? That was 5 million shares, right? Where's the number of shares at? 5 million shares were awarded. So we got to get the common stock account, right? Because now these shares have issued. The vesting is lifted. These shares are issued, just like someone had given us cash, but they've given us 4 years of service. And so we're going to credit the common stock, 5 million shares times $1 par value, right? And then the excess is the 55 million. And the 60 million that we had put in paid-in capital here with this entry 4 times, we're going to debit that. So that 60 million is now gone. We credited 15 million a year to a cumulative balance of 60 million. Now we're going to debit that. So look at this. Any change in equity for this? No. No change in equity with any of these transactions. And so, and no cash is ever paid out. And that's where a lot of people argued, hey, there's no cash expense. It's just a slight dilution in equity. Why are we expensing this? But I would be on the side that, man, this is an expense of the company. It should be tracked, and it's pretty large expense for a lot of companies. Now, stock options are a little bit different because now we have some new terms for you here. Number one, exercise price, and so that's the price that gives the executive option to buy the stock, and we'll see this. Like in this example here, the exercise price would be $10. The market price is $25, so it has an intrinsic value of 15. So if the actual price in the market is higher than your option price, your exercise price, then that has some what we call intrinsic value. The executive. Day one, intrinsic value is going to be 0 because we're going to grant these options at the fair value on day one. But we've got a period of time. So there's a vesting period where we cannot exercise these options. In my case in Lennox, that was 3 years. And we'll look at a different example here. But I had all the way from year 3 through year 7 to trade those stock options at whatever date that I wanted to. So I could watch the stock price. If the stock price went up, boom, I'd be out in the market and I would trade the ones, but only the ones I was vested in. And so I could look at Fidelity and see all the stock options I'd ever been granted, which ones were not vested and which ones were vested. And so that I could call Fidelity and I could exercise the ones that were vested. And so again, in a growing company, this could be worth a lot of money. So now we get into fair value. Let's say the exercise price day one is exactly the same as the fair market value of the stock. Let's say the stock was trading at $100 and someone gives you an option to buy that stock for $100. What's the intrinsic value? Intrinsic value is 0, right? Because I could buy it for 100, but I'd sell it for 100. But I have an option over 7 years to wait for that stock to go up. Now it could go down. So highly volatile stock could go way up or way down. That actually adds value for an option. So this option has a value, even though the intrinsic value is 0, because I got 7 years to wait for that stock to grow. In Lennox case, that was crazy because when I started, the stock was 20, and I ended, the stock was 250. And so when I was granted options along the way, I had high intrinsic value on that I was able to exercise the options and sell them at a higher price and make decent money. I will use the Maytag example because our stock price was going down and I had a negative intrinsic value, so my exercise price was high, but the fair market value was low, so I wouldn't trade those. I was praying, hoping for the stock price to come up. Now, unfortunately, it did not come up, and Maytag got bought by Whirlpool, so this can go in both directions. But the key point here, now we've got to estimate the fair value of these options. And there's a Black-Scholes model. There's a lot of theories when you take your finance class where we will value options. Obviously, in accounting, we don't have the expertise in most accounting departments to do this. Really, truly beyond the scope of this course. So here, the value of these stock options will be given to you every single time. Not much different than the real world, because we went out, we transacted with Price Waterhouse as a consultant. Price Waterhouse would come and look at our plans, and they would give us the value of the stock options. And so that was a given to us, just like it will be to you in the course. Now, Price didn't do the accounting, we had to do the accounting, so you need to learn this. And so the pricing model is going to consider the expected price of the option, the term, so a longer term will create greater value, current market price, dividends will feed into this, and whatever the risk-free rate, and then finally, expected volatility. If a stock is highly volatile, up and down a lot, big swings, there's a big chance it'll swing up. So higher stocks that are more volatile, the options to buy those stocks are going to have a higher value. And so all this is considered to determine the price and the value of that stock option. So here we go. Here's an example. Universal Communications grants options to buy 10 million shares, usually a lot larger number of options, and the exercise price is $35, and that's also the price on the date of the grant. In fact, again, the accounting changes if that's not true, and so this is nearly always true because people don't like the alternative accounting approach. And so the exercise price is going to be equal to the share price on the date of grant. However, so the intrinsic value would be 0, but the fair value is going to be greater than 0 because in this case, the company has how many years? 8 years. They've got 8 years to trade those stock options. And so there's a 4-year vesting requirement, so they got to wait 4 years. But after 4 years, years 5 through 8, they could just sit around and wait for that stock to go up. And then after year 4, they could trade those options at any point in time. But again, what's the principle that we follow here for this accounting? Fair value time per option at the date of grant. And the fair value is given to us, it's $8 per option. In other words, there's a high probability the stock will go up, and it'll be that these options will be at least worth $8 per share. And time value money is factored into that 8. And so, again, no entry, date of grant. What do we do? What's the first step we do in all of these? We're going to calculate the total fair value granted on day 1. What's the total value granted? $8 given to us per option. How many options were granted? 10 million options. So 8 times 10, 80 million. So executives were granted $80 million worth of options, fair value, given to them day 1. But, and here's the big but, they have to be there at the end of 4 years. And if they leave before the 4 years up, sued, if they are terminated or whatever, there's no lawsuit involved. You lose them. That's it, by contract. So we'll take $80 million divided by the 4 years they have to serve, and we're going to expense it at $20 million per year. So the accounting is really not much different. So for all 4 years, 2018, 2019, 2020, 21, we're going to debit compensation expense, salary expense for $20 million, and we're going to credit paid in capital stock options. So at the end of 4 years, we're going to have $80 million sitting in that account. But we've got a little more complexity when we get to the final entry. Now we'll get to that in a minute. Let's think about this next topic here, which I hit the slide. Forfeitures. Not everyone is going to make it. 20 to 30% of people are not going to make it. And so we've got to estimate the amount of forfeitures, and we're going to reduce this expense based on estimated forfeitures. Every quarter at Maytex, very interesting conversation, we would think about the forfeiture rate. Again, fair value, day one, doesn't change. But we got to consider forfeiture rates will change along the way, and we have to take those into account. Ignore the fair value changes, but forfeiture rate changes. And so every quarter, I would sit down with the VP of HR and my director of technical accounting, myself, in a room, and we say, hey, what's the forfeiture rate? Are we good or bad? Because the VP of HR, he would know some big executive is being let go. But he couldn't tell us who, he could tell us why, but he said, yeah, forfeiture rate's going to change. We say, hey, who is it? Is it me? We would laugh about it, but he would have information that we could not ignore that information because we're sitting down in accounting. So we'd have to involve people who knew, and we were estimating future forfeiture rates. And so, for example, sometimes there'd be a big restructuring in a division that a lot of executives would end up losing their job, and so we'd have to take that into account. There's going to be higher forfeitures out there. We were not privy to how many who, but we had to involve and trust the VP of HR. And when you get into your internal controls class in auditing, a lot of Sarbanes-Oxley controls were put around the calculation of this forfeiture rate. A lot of judgment involved. All right, so we're going to take into account forfeitures and how this handles. Now, I'm not sure if it's on this slide or a future slide, but we have two different ways of doing this. And the FASB and the codification allows you, it gives you an option to pick one way or the other. One way is I'm just going to estimate all my forfeitures in the future from day one. And if I think they're going to be 5%, I go ahead and I reduce my expense down by 5%. Second way is, well, I'm just going to wait till the forfeitures occur. And so I go ahead and book 20 the first year, and as forfeitures occur, I will make the change in the expense. And so in both ways, there's a bit of complexity around how we make the change. And so I want to get into that here. So here, this company is estimating 5%. So 2018, they did 5%. And so that 20 was reduced. Remember, it was 20, reduced by 5% down to 19. So they booked 19 and 19. But here you go. In year 3, the estimate is changed to 10%. And this is why I had that meeting with the VP of HR, because if the estimate of forfeitures is going down or up, I got to revise my expense in the year that I find out the new information, in this case, in year 3. So years 1 and 2, we were able to just keep going on a 5% forfeiture rate, but something happened in this company and more executives are being let go. Maybe it's bad performance in the division, maybe it's restructured, whatever. There's going to be 5% of those, more of those grants are going to be forfeited. And so here's how we do it. We'll see this as we work problems. We catch it up in year 3 on a cumulative basis. And so we go back, that original grant was 80% times 90% times 4, so 19 plus 19. That was where we were booking it, but now we need to be at, I'm sorry. Here would be the full, step 1, I'm sorry, let me take a step back. Step 1, we're gonna go back and recalculate the full value of that grant, including a 10% forfeiture rate. And so that's going to be the 8 times the 10 million shares, the 80, times 90%, because now we assume a 10% forfeiture rate, times 4 years. And so, and then we're going to subtract out how much we booked in the last 2 years, and plus this year. And so here we're going to book 16. So we need to be at, this is the answer right here, I'm sorry. We need to be at 16 here because we take 80 times 90% times we've been through 3 out of the 4 years, 3/4 of that value at this point, minus what we've already booked, so we have 16 left to catch us up. It's a catch us up on a cumulative basis on year 3. Let me say it a different way. If we had known all along that it was a 10% forfeiture rate, this is where we would be on a cumulative basis. We're not there because we booked 19 and 19. And so we're just going to book the difference here. We'll see it better when we work problems. Debit compensation expense for 16 and 16. And then the last year, this one is pointing to the last year. Now we're at 80 times 90%. All 4 years are done, minus 19 plus 19 plus 16, 18. So it's always done on a cumulative catch-up basis. So where should we be at year 3 if there's a 90%? Minus what we booked so far. I'm booking my catch-up entry there. In this case, that was only 16. In the last year, it was 18. So notice, with the higher forfeiture rate, there's going to be less expense, right? We're granting only 90% versus what we thought was going to be 95% would be granted. Now we're like, so the expense is lower. And so that 19 comes down to 16 and 18. By the way, I would just say, if we'd have known all 4 years at 10%, it would have been 18 every year. We didn't know that. We did the first 2 years at 5% forfeiture, and then we had to catch it up to that 10% rate here on a cumulative basis in year 3, and then the last year we didn't have any change in the forfeiture rate, so we came out at 18. So this is probably one of the curveballs in this chapter and how to calculate changes in the forfeiture rate. Now, as I said, there's another approach, which is, hey, I'm going to ignore forfeitures. I'm just going to book them as they come. So this is same fact pattern, but we had 80 million divided by 4 years, no forfeitures years 1 and year 2. So we just say, hey, we're just going to book 20 a year, 20 a year. Kind of ignorance is bliss. We know forfeitures are come, but the FASB allows us to make this policy election. It has to be, you can't change it year by year. You make a policy election and you stay on it. And so here's this policy election for this company is we're just going to ignore forfeitures until they happen. So 20 in expense year 1, which is 1/4 of the full 80. 25% in year 2, again, 20, which represents 25% of the full 80. Now we get to year 3, same kind of cumulative math problem here, because we got to say, hey, now, we just had forfeitures in year 3, so that 80 got reduced down by 10%. We know it because the forfeitures happen in year 3. So in this method, we account for forfeitures in the year they happen. We don't estimate ahead. However, we follow the same process. We look at a cumulative catch-up entry. So now we know it should be 80 minus 8, 72 times 3 out of the 4 years. That's where we need to be right now, minus what we've already booked, 20 and 20. So now, instead of that 16 in the previous example, we debit 14, which is the catch-up entry. And then the final entry ends up being the same in this method because we need to be at 80 minus 8, 72 times the full amount because we're in the last year, minus what we've already booked, 20 first year, 20 second year, 14 third year right here. And so we have 18 left to go. So if you think about it, step 1 is calculate, hey, what's the new total value, including our current estimate of forfeiture rates. And for this year's expense, I minus what I previously expensed to get to, if I was in year 3 out of 4, 3/4. If it happened in year 2 out of 4, 1/2. And so I get back to that minus what I previously booked. And we'll see this in problems that we work. Now here's the entry I thought we were going to get to. Stock options has a little bit of a curve here because we're going to receive cash. And so these were at $35 per share. And so when all, it doesn't happen like this where everybody goes out and exercises options on the same day. Well, it does half the shares, 5 million shares are exercised. And the market price is $50. Now, we don't get $50 per share. The employees are going to pay us $35 because that was their exercise price. They're going to get stock worth 50. They can go out and sell it for 50 because the intrinsic value only for the executive is $15 now, because they have an option to buy the stock for 35, and then when they get that stock they pay 35 for, they can go out immediately, instantaneously sell that for 50. So the executives are going to get a $15 per option value out of this. But we don't care about executives here. We're trying to do our accounting. We're going to receive the exercise price, $35 times 5, so $175 million. We're going to reduce the paid-in capital that was sitting there, that we put in there. That's what we expense. Remember, half of these, we put 80 in there. There's half left at 40 in this example, without forfeitures. And guess what? Now we have a new 5 million shares out there. So this part of the entry is all the same throughout the chapter, pretty much, right? We're going to credit common stock for 5 million because we got a new 5 million shares times a dollar par value, 5 million, and whatever the plug just goes into paid-in capital. Now, this happened a lot in my prior company at Maytag because I had options at 40 and 50, 60 bucks per share exercise prices because our stock was doing really good. Well, this is the opposite story of Lennox. When I left Maytag, I think the stock got down to $8 a share, and I think it finally sold to Whirlpool at $21 a share. Well, all my options were at $40, $50, $60 a share. So only a stupid man, a crazy man, would buy it for 50 and then sell it. So the intrinsic value was negative. So I never exercised those shares, and none of the Maytag executives ever exercised those shares. They're just, and when the term date comes out in the 7 or 8 years, and the option's dead, then we got to take them off the books, right? And so we just credit paid-in capital, expiration of options, and debit. Just a very, very simple entry here. Hopefully, when you get stock options, they're all going to have great intrinsic value, and none of them you never get to the end of the term of the stock option, and they're worthless. And so I remember being at I'd taken one of the administrative assistants to lunch on administrative assistant day, and she was going on and on about how the executives were overpaid and all that. It was really surprising. I said, well, my stock options are worth less than this lunch I'm buying you, because they were all worth zero, so anyway. So and the last type of stock option a plan is performance shares. And so these are shares at Lennox. They could be paid out between 0% and 200%. So there was a share grant, like I knew I have been granted, let's say, 5,000 performance shares. And they could be 0 shares or 10,000 shares, depending on the economic performance. And that was really laid out. If we achieve these targets, performance targets, our targets were, our primary target was return on invested capital. And if we hit the return on invested capital percent based on the financials, and if we exceeded it, it could pay up to 200%. Or if we didn't meet it below a certain threshold, they'd be paid out at 0%. And so, in fact, at Lennox, I think they went up to 225%. So, also highly valuable in a high-performing company. I was fortunate that Lennox was high-performing. A lot of them paid out at a higher rate at 200%. So, the one issue here is you got to come back and you got to decide all along, like a liability almost, it's not a liability, but what's the probability of this paying out? So we would have to look at all our performance share grants every quarter, in fact, and say, hey, are these going to be paid out at 100%, 150, or 0? And initially, and so these grants had a vesting of 3 years, so it's a performance over 3 years. So generally for year 1, it's hard to guess what's going to happen in year 2 and year 3. So in year 1, we typically book those at 100% payout. When we got to year 2, we started seeing, hey, are we doing better or worse? In year 2, we start revising that 100% up or down based on how we are measuring against and forecasting those. And so all the other accounting will stay the same. Like for here, if the expectation is 0, then you could book 0. And so you'd have to do the same thing. So again, here, the journal entries are all the same. it's that multiplier effect that you have to think about. You're still going to debit compensation expense. You're still going to credit paid-in capital, and the numbers will multiply here. I'm not going to have you do a problem here, but I think this one is good to know. I'm going to skip by this. And then the last topic here, not the last topic for this chapter, there will be another lecture on earnings per share. I'm going to separate these two out, kind of shorten up the YouTube video here. But employee purchase plans allow employees to buy stock at a discounted price. And at Lennox, that was 5%. At Maytag, that used to be 10%. You could buy shares all throughout the year, withholdings out of your paycheck at 90% of the value. But the accounting changed there. And so you see here, if the discount is no greater than 5%, you do not have to worry about the accounting changes. So Maytag canceled their plans when their rules changed. If it's greater than 5%, that's why Maytag canceled it. Let's say here it's discounted by 15%, and the common stock market value is 1,000. Then you are required to record compensation expense for that discount factor. Again, if they're less than 5%, you record nothing. And I just want to touch base. I'm not going to do a lot of, I may not have any test questions on this, and you can read more about it in the book, but I know you will see this in companies where you're going to be working. So that is the end of share-based compensation. Again, please read the textbook. You need to supplement lectures, not only just online, but even if we had physical classes here, you need to be reading this textbook to get the concepts. We will move into earnings per share lecture next, and then I'll start working problems, both share-based compensation problems and earnings per share problems. Thank you, guys.